All right, a very warm welcome to this special episode of Market Pulse, where we're having a conversation with the Central Bank Governor Kamau Thugge on the developments, particularly in Kenya's banking sector. Governor, welcome to the program.
Thank you very much.
All right, so a lot has been happening in the banking sector, particularly in as far as the behavior of, or rather access to credit for private sector. And I just want to get your thoughts. There's been a lot of push and pull between the central bank and the financial sector. And I want to know that where are we today?
Well, thank you very much for giving me this opportunity to explain this new way of pricing loans. Before I do that, maybe just give a bit of how we got where we are. You recall in 2016 we had Parliament obviously was very concerned about the high interest rates at that point, and which they thought was affecting the expansion of credit to the private sector from the banks. And their solution was to cap interest rates with the idea that the lower capping the rates will encourage more borrowing from the banks, and the banks would also lend. So capping was introduced, I think, was around November of 2016, and for the next 3 years, what was expected did not happen. And in fact, the opposite happened, which is that credit to the private sector dried up compared to where it was before. And by 2019, it was clear that the framework needed to be changed. That regime of capping was not achieving its original purpose and therefore needed to be changed. So the central bank started the process. They came up with the banking sector charter, which had essentially 4 pillars. One was a risk-based credit pricing model, which would then replace the capping regime. It also includes a pillar for customer centricity, transparency, and really ethics and integrity in the banking sector. This framework was then implemented towards the end of 2019 and essentially took into account several factors. One, the cost of funds. Second, the cost of providing the loans. 3 was the shareholder return. And these 3 comprise what was the base rate. So each bank came up with a base rate comprising of at least these 3 items. And then they added the risk profile of the particular borrower, and that's how they came up with the lending rate. So it has been operating since 2019 to up until last week, essentially. But in its operation, we realized it had quite a number of shortfalls that needed to be addressed. And those shortfalls included the fact that it was not very transparent. As I said earlier, each bank had its own base rate. And because it had, each bank had a different base rate, it was really difficult for, I think, borrowers to determine which banks were offering a better rate. It was not, therefore, transparent. In addition to that, we felt that it was biased against borrowers, in the sense that when the rates would go up, the commercial banks would immediately raise their rates. When the Monetary Policy Committee decided to raise the CBR, the banks would follow immediately. But when the time came to really stimulate the economy and get more credit going to the private sector by reducing the policy rate, the CBR, we saw some reluctance on the part of the banks to lower their rates. In fact, since last August, we've lowered the central bank rate by 350 basis points. Some banks have reduced their lending rates by that much, but a lot of banks haven't.
Yeah.
And so had we had the framework, and I'll come to the new framework, had we had the new framework, we would have seen actually lending rates reduced by at least 350 basis points. Mm-hmm. The other thing we realized was that it was not transiting the monetary policy decisions as effectively as it should. So this new framework, we decided to have a new framework this year. We had a paper, a consultative paper that we circulated for public consultation and for comments. We got comments, local comments and international comments. And at the end of that whole process, we came up with a new framework which is founded on the Interbank rate, which we are renaming KESONIA. So the whole framework uses that as the anchor, and then banks set the a premium K on top of that KESONIA. Mm-hmm. KESONIA stands for the Kenya Overnight Interbank Average, and it's the same kind of naming that you find in the US and the UK. So the banks set the K. The K we are saying can be positive or can be negative. In other words, if you are, if you're a very valued customer to a bank and you don't have any risk attached to you, yeah, the bank can lend to you at KESONIA -1 or -2. It doesn't have to be KESONIA plus something.
Right. So, Governor, the question that comes to mind is, with the previous model, what banks then were required to do is submit their pricing model to the CBK for approval. In this new framework, that is likely to not be the case. And the question that a lot of Kenyans are asking or would want to know is CBK then surrendering that role of ensuring that consumers and customers get fairly priced to the banks and letting banks sort of run wild?
It's true. We are not requiring the banks to come to us for approval of the K. The K will be determined by the banks. But the new system is very transparent and will provide a basis for borrowers to be able to, they have more information. Mm-hmm. They can negotiate more with their banks. They can negotiate for a lower rate given their risk profile. And if they don't get that lower rate, they can go to another bank because they know the K for each of the banks. And I think importantly, which is more positive for this new framework compared to the previous one, is where, as I said, in the tightening phase of monetary policy, we noticed that the banks were quick to raise the lending rates. Yeah. But now with this new framework, even reduction in the policy rate, the CBR rate, will be accompanied by a reduction in lending rates, yeah, and much more immediately, because the current monetary policy framework we have now ensures that this KESONIA, the anchor to the framework, is actually very close to the CBR. So every time we change the CBR, through our open market operations, the KESONIA also changes to match where the CBR is. Mm-hmm. And since all loans, the base for all the loans is going to be KESONIA, we have an immediate impact on the lending rates by the commercial banks. And this is what we didn't have before in the previous arrangement, especially for when the rates were going down.
Even basing that on your argument, that then this will translate that the difference between KESONIA, which is the interbank rate, and the central bank rate isn't that much, then why not stick to the CBR?
Of course, as you know, that was our original position, and it was actually based on the similar thinking that you have, which is that if they are both the same, what difference does it make if you use one over the other? But I think we are convinced by practices elsewhere and in the comments that we received, that we are also trying to develop our financial sector and to modernize it and to bring in even more financial products. And a strong case was made that if we're even going to a situation where we might even have a derivatives market or a swap market, that requires a market-based reference rate and not a policy-based rate. So I think with all that, we felt that fine, let's move to the KESONIA as the anchor to this framework. And indeed, for us, it was easy to move to consider that, both because it allows for the development of new financial products, and two, it's still the CBR and KESONIA under the existing framework were going to be the same. So actually we got the best of both worlds, I would say. What
measures is the central bank going to put in place to ensure that then banks don't take advantage and start charging customers exorbitantly?
Yeah, we are now starting with the reference rate that is common for all the banks. Mm-hmm. And all Kenyans, all borrowers know that now the reference rate is the KESONIA, and it's the same for everybody. Mm-hmm. That's the first point. Second, because now of the transparency of the K, you will be able to know the K for one bank A, for bank B, bank C. So it gives you some knowledge that you didn't have before, with which you can actually go and negotiate with your bank. So this increase in transparency is what will curtail banks from going overboard and charging high rates, because it will be very obvious that if your K is 10 and another bank's K is 5, most people would prefer to go to the bank that is charging the K of 5 rather than the K of 10. So I think inbuilt in the framework is competitiveness, which will hold down the level of lending rates.
What are some of the safeguards that you're putting in place to make sure that then not only will the customer have the option to move to another bank, but as the central bank, that the rates then don't go in the zones of 20% or 25%?
Of course, we'll be monitoring this very closely, and we expect the banks to be publishing their lending rates, the average lending rates, including their average K on a monthly basis. Yeah. And they will be publishing, but also sending it to us. So we will be aware of what banks are doing. And then, if we see something is amiss, then, of course, we can have a discussion with those particular banks.
How do we make sure that even as banks continue to extend credit to the private sector, they're not cutting off a certain category of customers based on their credit worthiness or their risk potential?
Yeah, I think I would say that's the beauty now with this framework, mm-hmm. because it doesn't restrict the K. In other words, if you are a very risky customer and you don't pay your loans on time, it's not that you are prevented from accessing credit. The credit will be there, but the price will be high. And so I think it caters for all kinds of, from a very risky person to a least risky person. So I don't think anybody is prevented from accessing the funds because of their high-risk profile. That will be reflected in what you're charged by the bank. So,
Governor, how high is too high when it comes to the interest that then customers are going to be charged?
Yeah, again, obviously, that's a difficult question to answer. What I would say is that the framework that we are implementing and putting in place now addresses many of the issues that that the previous framework did not address, and that is of transparency and competitiveness. And I believe that the pair of transparency and competitiveness is what will drive rates lower as opposed to rates going up. And I do think that with having a common base for all the banks and having the transparency for K, and to be able to, for borrowers to know what each bank is charging for K, that combination will ultimately result in competition and lower lending rates. So,
Governor, we've been speaking about lower lending rates even with the previous framework, and one complaint that we kept hearing from a lot of customers is that despite my risk being very low, being a corporate client and I pay my loans on time, my rates have never come down. How do we make sure that this time we're actually going to see banks lowering the rates for the customer with lower risk?
Yeah, the new framework is much more transparent. The old one, I think people didn't really know how the rates that they were paying the banks were being calculated. So I think we under the new framework, yes, the base is known. The K, we will be able to get the details of the K as the regulator, and for the risk part, we'll be able to look and see whether it makes sense from a qualitative point of view, a quantitative point of view, so that it's also not used to as a way to just raise rates without really a foundation for raising the rates.
Governor, I want to know, in what scenarios are we likely to see the intervention of the central bank? At what point does the central bank then come in and enforce the regulations where we're telling banks now, on this one you've gone overboard and we need to make sure that you play within the rules?
Yes. The requirement will be for the banks to, as soon as their boards have approved the new framework, within 15 days, they must send that framework to us. Yeah? So that sort of becomes the baseline. Yeah? And that's how now they will be pricing their credit.
Yeah.
They will be required to report their rates, the average lending rate, but also the average K. We'll be able, therefore, to monitor even off-site whether what they are reporting on a monthly basis is consistent with the model that they sent to us. Yeah. If we see a large discrepancy, then that will be a reason for engaging the bank and to understand why they are deviating from the model that was approved by their board.
All right. So earlier in the year, Governor, what you told us is that the central bank had started on-site inspection of banks, and we've never been able to understand what was the outcome of that on-site inspection and what were the findings and which banks were penalized.
Yeah. So it's an ongoing process. Although we are coming to the end of it, we were able to on-site inspect all the banks. We did do the reports for all of the banks, which we sent to their boards. We have discussed those reports with the boards. So now the remaining part is based on those discussions to now assess what kind of penalties there will be. So that is basically the next stage.
How many of them were non-compliant?
There were some that were broadly compliant. Some will be compliant on some areas, but not compliant on other areas. There were some who felt that following the formula would result in even higher interest rates following their own model would result in higher rates, so they did not apply the formula.
Yeah.
And that's why under this new framework, because you have a common reference rate, it will now be easier to ensure that the banks follow on their models that have been approved by their boards, and we can monitor and make sure that they are following on those models.
All right, so Governor, let me take you back. When risk-based pricing started, I think in 2019, banks are the ones that came up with these formulas. Then years down the line, the same institutions were not following their models. So here we are in 2025. We are going down that road again, where there's a new framework and banks are saying, we want to propose a new formula. So what is to say that this time it's going to work and we're not going to have a similar scenario that we saw with the previous model?
Yeah. The nature of the framework is very different from the previous framework.
How so?
As I said, one, there was no common reference rate in the previous framework. It was very opaque. It was not very transparent. It was in favor of the banks and not the borrowers. And in terms of the transmission of monetary policy, it was not very effective. The new framework addresses all those issues. We have a common reference rate, we have transparency, we have a level playing field, because now when rates go down, borrowers will feel the lower interest rates, and monetary policy will be more effectively transmitted to lower, ultimately to lower lending rates of commercial banks, much more than it has been done in the previous framework.
So, Governor, do we have a timeline that if the MPC meeting happens today and the rates are lowered, that banks within 24 or 48 hours then need to reflect that? Yeah. Do we have that time?
In fact, the time is immediate. Let me just give you an example. Let's go back to August, when we changed the rate from 9.75 to 9%. If we were to lower the rate from the 9.75 to 9.5, and that decision is made today by the Monetary Policy Committee.
Yeah.
The next day, we go and intervene in the market, supply more liquidity to the market, interbank market, and KESONIA, that was close to that was 9.75 the previous day, also now comes to 9.5, the same as the CBR, the policy rate.
Yeah.
And because KESONIA is the anchor, is the foundation for all the loans, immediately on that day, the lending rates should come down.
All right. So another category that of players that plays within the credit market in the country, we know these are digital credit providers, and I want to know: have you had a conversation with them on the new framework, and what has their response been, and also how is CBK likely to enforce that? Okay.
For the time being, this framework is applying to the commercial banks and mortgage finance providers, the banks. And for any digital credit from the banks, that is also follows this particular framework. Outside the mortgage finance and the commercial banks, it will be a process. We'll have to engage all the institutions that we regulate and license, especially those that provide the credit, to see how we transition them from what they are doing now to this particular framework. So it's a process. Right now we are starting with the banks and the mortgage finance banks.
All right. So, Governor, even as just before we move this conversation on credit pricing forward, there's a question around the cost of credit. Now, we've seen a number of banks saying that when the rates were high, banks were still paying taking high cost for deposits, and that was the reason why they were not extending credit to the private sector. Now, we have a framework that then banks are supposed to incorporate their cost of funds into. What guarantees can you make to players, particularly in the SME sector, that going forward with this new framework, you're going to ensure that credit is unlocked?
Yeah, I think what I would say is under this new framework, the way I envisage is that the KESONIA is given. But when an SME maybe goes to a bank, at that point, KESONIA is known. They are given the K, which has factored into the cost of operations and the shareholder return and the risk. Then that K would then be agreed and fixed. Mm-hmm. Yeah. So the only thing that would be moving during the contract period for that loan is the KESONIA.
Yeah.
So when we lower the KESONIA, the rate for that loan to that SME goes down. Mm-hmm. So that is all I can give in terms of the guarantee, in terms of the framework. K is not something that the banks will just wake up one day and just raise it.
Yeah.
Yeah.
All right. So let's switch gears and move this conversation to the broader space, and just looking at what has been happening in the FX market and where our currency has been. Now, in the last MPC meeting, what the central bank told us is that we have 5.2 months worth of import cover. That was not the case a few years back, and we saw that we were getting to a point where even financial institutions were holding on to their foreign currency reserves. So how do we make sure, Governor, that we don't go back to that point? What measures has the central bank put in place to ensure that we don't get back to a point where banks feel the need to hold back the foreign currencies that they have? Yeah.
I think in the last 2 years we've had introduced a lot of reforms in the foreign exchange market, mm-hmm. including introducing the BMatch, this electronic trading, and which introduced a lot of transparency and price discovery. Of course, in addition to that, I think the measures that we took in terms of interest rates, in terms of the liability management for the Eurobond, the combination of all that has stabilized the exchange rate. But in addition, the current account is fairly strong. Investor confidence is fairly strong, and you can see in terms of the performance of the infrastructure bond and also other just normal bonds, we get a lot of portfolio inflows into the country. But the most important, I think, element in that is the exports. Yeah, exports which have been doing relatively well. Especially coffee has done very well. Tea is struggling a little bit. Horticulture is also doing very well. Textile exports are also doing very well. Yeah, so that is very positive. The remittances have also been very strong, yeah, and very steady. And of course, tourism. So I'll put those three: exports, remittances, and tourism have been very strong. In fact, they have been the major contributor to the stability of the exchange rate. So that when foreign investors invest in treasury bonds, they can also very easily remove the money. Similarly, if they come to the stock exchange, they can very quickly. So that can be a source of destabilization. But because the main stabilizing factor are these recurrent receipts that don't change that quickly, we believe that that stability of the exchange rate will continue.
All right, and the reason I ask that is because currently, as we speak, Kenya is not in an IMF program, and we know that these programs also help to boost our FX market. And I want to know, where are those conversations with the IMF? Have they started, and when are we likely to get into an agreement on getting on a new program?
Yeah, our intention is to engage with the IMF in actually this month. They are coming this month, and to engage with them on maybe even a 3-year arrangement. Yes, maybe under the same framework as we had in the previous one, the one that expired in April. Yeah, so we're expecting them this month to start discussions and negotiations for a new arrangement.
Okay, and do we have a timeline when maybe you expect a decision on that?
I think that will become more clearer once we start the discussions.
All right, and I believe towards the end of this month is when we're expecting to also get a governance diagnostic from IMF. And so what impact do you see that diagnostic playing?
I would put them as two different developments. I think the government diagnostic deals with different issues of governance. It also addresses, even for the central bank, I think there are some issues that we need to, for example, representation of the MPC, who should be in the MPC, or representation of the board. Those kind of governance issues, not corruption issues. So, one, the diagnostic was important to as part of the process of getting to negotiate an arrangement. And of course, it's also possible that there could be recommendations from the governance diagnostic that could ultimately find themselves in the agreed arrangement.
All right. So, in closing, Governor, how do you, when you assess the liquidity within the country and in the market, do we have sufficient liquidity? Do we have enough money being supplied in the economy, or do we have a scenario where money supply is on one side, but on the other hand, there are those that feel that we do not have enough liquidity in this segment?
I think we could do better. As I said, credit to the private sector grew by 3.3% in July. And the broad money supply, the overall increase in money supply was a bit higher than that, was almost 8%, about 7.5%. And normally you'd expect money supply to be also driven by credit to the private sector, except in this case what we've seen is that this improvement in money supply has come mainly from the good performance in the balance of payments and in the build-up of the net foreign reserves of the central bank. Because by buying those dollars, and we, as you know, we have now been able to build our reserves to the highest level. It's almost about $11 billion. By those purchases, we are also supplying the market with the shilling liquidity, and that has also gone to support the growth in broad money supply. So, with the continued easing of monetary policy, we would expect credit to the private sector to increase towards the end of the year. Hopefully we can get it. If we can get it to 10%, that would be excellent. And that obviously would inject more liquidity into the economy. All
right, so there have been concerns. Now, I know that the limit in terms of how much one can withdraw from their account was increased. And I also want to understand, so just looking at that and the number of flagged transactions, particularly within the banking industry, where are we and what are some of the measures that the CBK is currently working to make sure that that is addressed?
Yeah, I think the increase in the limit for withdrawals was also in line with the Financial Action Task Force guidelines. So it was not something outside of that framework.
Yeah.
I think in terms of suspicious transactions, that you may get better information from the FRC than from us.
All right, thanks so much, Governor, for making time to speak to us, and really appreciate your input on these matters, and we'll be following up to see what happens, particularly in the credit market.
Very good. Thank you very much.